Hey everyone, welcome back to Yuri's Box. In this video I'm going to talk about TLT and give a brief update following the non-farm payroll report we just got a little under an hour ago. If you like this kind of content, consider leaving a like, and as usual, nothing in this video is financial advice. So in the lead up to today's number, I really had mixed feelings. I didn't know what to expect. If you recall in yesterday's video, I hinted at the fact that we could get some ridiculous number like 200k, given the fact that when we went through all of the PMIs and ISM reports, yes, the overall vibe, right, was quite negative. The outlook for the future is quite uncertain, and that has remained consistent ever since February. On the other hand, March kind of picked up a little bit when compared to February. So that really led me to really not give a forecast when it came down to the non-farm payroll print, because I could easily make the case for both things, both something like 50k and something like 200k. Given the fact that we have low confidence in the future, why would you hire? But also, given what we saw in the various reports, things kind of picked up in March. So, you could have easily expected something like 200k, which is exactly what we got. We got a blowout number once again. Consensus was for about 140, and we got 228. What I also pointed out in yesterday's video is that given the fact that we are in a completely new regime, there would be the potential for this number to be completely ignored. And you kind of get some of that this morning. Before the non-farm payroll print got released, yields were more or less around this area here. Now the 30-year yield was lower by, I think, a couple of more basis points. It was at 435 or something like that. Granted, yields have moved back up just a smidge. It's nothing too dramatic. We're still at session highs for TLT, which means session lows for yields. And so for the moment, the market is looking past this strong number, given the fact, again, as I pointed out in yesterday's video, you could really easily make the case that given the fact we are in a new regime entirely, we're dealing with a potential of a trade war, it doesn't really matter. It's in the past. This is part of the past. Now we have to look forward and what will happen. Now, I wouldn't extrapolate too much from the movements that we have today. I think it's always best to have a cool head. And I think that one of the areas you'll have to look at is something that I've pointed out in my previous videos, which is credit spreads. I think if there is one area you want to pay attention to, it's really credit spreads and how are they behaving. Because if you continue to see follow through, and really another way you can visualize this is just by looking at HYG, the high yield ETF. Now, granted, you might say this is just down 1%, so no biggie. But what you really have to keep in mind is that what you're measuring is the differential between something like TLT, right? You're measuring treasuries against high yield bonds. So again, something like this. So the move is exactly 3%. You put the two together. This is one area of the market I would pay very close attention in the following week. and really following weeks, really to gauge sentiment and see if this is actually, something big, or if it's just something that, is really just passing by. Going back to the non-farm payroll report, we did have an upside surprise to the unemployment rate. And the only way I could have imagined seeing the unemployment rate move up, as I said in yesterday's video again, is if we saw the participation rate moving up. Given the fact that if you look at how initial jobless claims came out this month, they were pretty benign. The latest print was 219. And, my kind of line in the sand, as I said in my previous videos, is 215 to 220. Whenever you see anything below 215, you can generally expect the unemployment rate to drop. If you see anything above 220, you generally can expect the unemployment rate to move up. We've bobbed around, the 220 to 225 range in March, which really isn't that enough. It really isn't enough to move the unemployment rate significantly higher. However, if we were to see, and which we actually did see, the participation rate move higher, that could artificially, quote unquote, move the unemployment rate higher, which is exactly what we got. And again, we have 4.2 on the unemployment rate for the month of March. Honestly, I don't really know what to make of this unemployment report. I think that for the time being, I think that the markets are somewhat correct in fading kind of the importance of this report. However, it does give at least some ease to markets, because if this non-farm payroll report had come in tragic, all right, I'm saying 50k on non-farm payrolls and 4.3 on the unemployment rate, that would have lowered the starting point going into the tariffs. What this does, this really strong jobs report, it just helps the markets kind of to, at the very least, say, yes, we're going into a rough patch, but at least the starting point isn't bad. It's good. It's still okay, which I think is the reason why you've seen rates kind of move up from session lows. As I said before, now that I'm speaking, they're slightly edging higher by a couple of basis points. Overall, there will be short-term fluctuations. As far as, things are concerned right now, it really is about the tariffs, and the second really is what is happening on the fiscal side. So we lack new stimulus. We're debating in Congress whether to extend existing tax cuts. So we still don't have some of the goodies, all right? And we're putting on pressure with this tariff story. And I think it'll pay to watch closely what happens on the tariff side. And if you have some kind of retaliation, which I generally expect, I don't expect this to be immediate, simply because Trump really can't back down. I mean, he can. He definitely can, and it wouldn't be a shocker. Absolutely not. What I'm saying is that if he were to back down because of what is happening in the markets, I mean, there's no going back politically from something like that. I mean, it's he really gave out the bazooka, and walking back the bazooka is, it would cost him immensely at a political level. Still could happen, absolutely. I'm not saying that couldn't happen, but it would come at a great political cost. On the flip side, if foreign leaders were to bow down immediately to the tariff threats, that would just be a show of weakness, of incredible weakness, in front of their own electorate. Which, I mean, it could happen. We could get some kind of news over the weekend that, European leaders say, oh, we're not going to retaliate. We want to come to the negotiating table. It could absolutely happen. What I'm just pointing out is that at a political level, it would be immensely costly. I mean, that's what I'm saying. Just like would be costly for Trump. So I'm expecting this to drag out at least for a couple of weeks. But again, things move very, very quickly. So, you really can't put too many forecasts out there because things move very, very quickly. As far as TLT is concerned, really bonds are the only thing that are working in this environment. And again, the reason is quite simple. It's risk off. And whenever risk off is on the table, the only thing that works really is bonds. I'd be curious to see gold actually, because gold has actually been suffering these last few days, and it's down on the day actually as well. So again, bonds are the place to be. Let's see how long that holds. It definitely is good news to see bonds perform well, for the simple reason that if you're in a risk-off environment and you don't see bonds performing, then you have a huge problem. Then you have really big problems that exceed any any kind of analysis on squiggling on charts. So in any case, that's one of the silver linings that you can take away from this. So just to keep things short, we also got while we're at it, average hourly earnings coming in softer than consensus and softer than really the previous number, which is curious given what I was talking about yesterday about wage growth and what we're likely to see from now on. It's still okay, but still the trend is lower, as you can definitely see. Wage growth has been sluggish, and I expect it to continue to be sluggish, given, for example, what good old trusty quits rate is telling us, and what it has been telling us, okay? But I went over this in yesterday's video. So again, to keep things short, or at least try and keep things short, Nonfarm Payrolls came in positive, but mostly the markets are kind of shrugging that aside, given the fact that we are an entirely different regime, with the added that at the very least, it helps to soothe any imminent collapse fears, all right? Because if, say, we had a 50K print on non-farm payrolls, that would have lowered the starting point going into the tariff, shenanigans, all right? So at the very least, this keeps the starting point high enough so that perhaps even the Federal Reserve doesn't have to panic immediately. Like we have Fed Chair Jerome Powell speak in a couple of hours, if I'm not mistaken. If we had 50K, I could easily have imagined him coming out and saying, yeah, you know what, the hard data's rolling over. We have to act next meeting with the 50 basis point rate cut. Given the fact we have 228, I could easily see them just sitting and waiting, more of the same. But that's, a subject for another video. Unemployment rate went up. Mostly, I would point towards the reason behind that is the participation rate having moved up a bit. But overall, the average weekly hours are still at cycle lows, which is, again, not a particularly great sign. Given the fact that, if there ever were to be, better economic outlook, one of the immediate things employers will likely do, instead of hire more people, they would just raise the work week. So that's the average weekly hours. Government payrolls beat, actually. They came in higher than even I was expecting. But overall, markets seem to be looking past this payroll report, just because we are in a different regime from now on. And we'll see how long it lasts. Things move extremely fast. So I would keep a cool head. I would not try to read too much into what is happening in the moment, because again, Trump can come out during the weekend and say something crazy, and it'll just flip the script once again, right? And it's not entirely unlikely, given the fact that, I mean, just remember where we were a couple of weeks ago. Did anyone expect something like this to happen? Absolutely not. But this is what we have. Does anyone expect something even crazier? I don't know, but it could easily happen. So be nimble, be flexible, and as far as TLT is concerned, as long as risk off is on the table, bonds are, well, they're having a heck of a time for the time being. We'll see how long that lasts. I'll be updating TLT as usual in the following days. If you like this kind of content, consider leaving a like, and I'll see you next time. Bye.